Hello, my name is Demetris Theophanides and I'm a senior private wealth manager at XSpot Wealth. In today's video, we will analyze the latest markets developments. During the past 18 months, Federal Reserve officials raised interest rates to their highest level in 22 years. Higher interest rates aim to cool down the economy by making it more expensive to borrow money, which discourages business expansions. Historically, 18 months is the average duration that has been observed for the high interest rates to have an apparent impact on the economy. So what is the impact of the economy, job market, and inflation today? GDP is still strong, and this is partly because banks continue to lend despite higher interest rates. In broad terms, an increase in real GDP is interpreted as a sign that the economy is doing well. Employment remained at historic lows for months. However, last month we saw a decline in employment and of course a rise in unemployment, which reached 3.7%. In a normal labor market, rising unemployment is a red flag. But last month's rise in unemployment is actually an indication that the job market is normalizing. Inflation picked up after a period of continuous decline. It is currently around 3.2%. Then the escalation of inflation continues, and the current inflation rate does not look threatening. The real estate industry is falling sharply. High interest rates and inflated home values have made purchasing a home challenging for first-time home buyers. Home sales are 31% lower for 2023 and 45% lower from their highs. The rate of decline is greater now than in 2008. The real estate industry affects many more industries, such as banks, appraisers, insurance, brokers, and furniture retail chains. The economic environment is changing. For now, it looks like the Fed's goal of a soft landing for the economy is within reach, and that's what the markets have discounted. A soft landing in the business cycle is the process of an economy shifting from growth to slow growth to potentially flat as it approaches but avoids a recession. As the Federal Reserve targets to bring inflation down to 2%, there is still some concern that the further increase in interest rates may tip the economy to a recession. We will continue monitoring the markets and watch for changes in inflation, the labor market, and interest rates in the coming months. Now let's look at some interesting statistical facts for September. Historically, September, the markets have the worst performance of the year. It is generally believed that investors come back from their summer vacation in September, and it is the time that they need money to pay for tuition or back-to-school items. Others speculate that investors want to sell to lock in gains accumulated during the year. Perhaps some sell-off occurs as mutual funds companies start to pay in distribution, which can trigger some tax selling. There is another interesting statistic related to the third year of the US presidential term. The months of January to August are strongly bullish, followed by 2 months of volatility. And then at the end of the year, usually there are impressive returns in the stock markets. In any case, past historical and statistical performance is not a clear indication of future returns. I will not be surprised if this year we have a better than usual September, since much of the annual stock sell-off took place earlier in the beginning of the year. In addition, some of the stocks hit hard at the beginning of the year are now attractive, mainly because their valuations already reflect further rate hikes. Do not forget that in volatile times, the best strategy is to stay invested for the long term. And in times of inflation, investing will ensure that you will not lose the purchasing power of your money. We are here to help and ensure that you will be able to achieve your long-term financial goals. Do not hesitate to request a free consultation. Thank you for watching another video related to economic and market developments. Stay tuned for more videos to come.